welcome to Investors Guide. We have a special half-hour planned for you today. We're going to talk about the portfolios that you should be investing your money in. Let me first invite Dhirendra Kumar into the show, the CEO of Value Research and our in-house mutual fund expert. He, of course, helps us with our recommendations and helps us plan our portfolios on this show. Dhirendra, thanks so much for joining us. Now, for those of you who remember, 2 years ago, when we started this show, we designed portfolios for various age groups. Now, the idea behind those portfolios is that we would invest hypothetically 10,000 rupees every month in SIPs into our own recommendations, and we've been tracking them to see how well they've been doing. First, let's start with our aggressive portfolio. Now, remember, this portfolio was designed for someone who's 25 years old or in that age group. So really, we're looking at someone who has a lot of time before retirement, who has enough time to see through as many market cycles as possible, and is willing to take in that risk of aggressive returns. Now, this portfolio had an asset allocation of 90% equity and 10% debt when we started off, and these are the funds we invested in: the Reliance Regular Savings Equity, the IDFC Premier Equity Plan A, Sundaram BNP Paribas Smile, DBS Chola Opportunities and UTI Opportunities, and of course DSP BlackRock Short Term, which is the debt fund in that portfolio. Then you are planning on making some changes to that portfolio right now, aren't you? What are the changes that you'd like to make?
The first change we have made is that, the relatively poorly performing small cap or, mid and small cap fund in our aggressive growth portfolio, we have knocked those off, and we have realized the full value. There isn't much gain, so there isn't much tax implication, and that is being replaced by more proven and more flexible positions, which is they are replaced by ICICI Prudential Dynamic Fund. I think it is proving to be an outstanding fund. So we have knocked L&T Opportunity and Sundaram Smile Fund from this portfolio, and it is replaced by HDFC Equity and ICICI Prudential Dynamic.
But then we know that this portfolio has been taken a beating right now because of its exposure to small and mid cap. So what makes us think that ICICI Prudential Dynamic will actually perform better than Sundaram Smile? What is the big difference between these two funds? Why are we moving money from one to the other?
It has, proving to be more impressive through the two decline we have seen so far. In 2008, it was able to withstand. Every fund fell, but this fund was able to withstand the decline much better. And the whole mandate that it can move, it has greater flexibility, it can take an allocation call. Though we don't encourage that, but sometime in extreme conditions it is helpful. And somebody being able to do that reasonably well, that is coming in handy. So that was one, and the other is HDFC Equity. It is, it has too long a track record and of compelling performance. And when we were constructing this portfolio, it was having a bad patch. That is why it was not part of our portfolio. But now I think it deserves being there, and in quite a significant way.
All right, so this is the change we're making so far. We had L&T Opportunities and we had Sundaram Smile. We are redeeming our money from those two funds and moving them into ICICI Prudential Dynamic and HDFC Equities. So flashing on your screen right now are the final funds in our aggressive portfolio. Now remember, we invest hypothetically in this portfolio as well, which means that we track its progress on a regular basis. We keep an eye on it and we make changes when necessary. So we're going to keep an eye on this fund as well. Now this is the fund, this is the portfolio that we are recommending for someone who's 25 years old. We're going to track it regularly and tell you how it's doing. Let's move on now to our growth portfolio with an asset allocation of 80% into equity and 20% into debt. This portfolio was designed for someone who's 35 years old, which means a slightly less exposure to equity, so a slightly lower risk. These are the funds that we had invested in: Birla Sun Life Frontline Equity, DSP BlackRock Top 100, HDFC Top 200, DWS Investment Opportunities, I beg your pardon, UTI Dividend Yield, Canara Robeco Income, and DSP BlackRock Short Term. Now, like we were talking about, in the last 2 months, this is another one of our portfolios that's taken a considerable beating, not on the principal is still intact, but on the returns that we had accumulated over the last 2 years. So obviously, you're going to look at making some changes at this point?
Yes, here we have made some very strategic changes, and we have not, I don't think we have anything to regret about our big positions. In fact, here two funds account for 50% of our portfolio, and they stay as it is. So we have made quite a significant change that knocked our fixed income position, and also knocked one of the relatively poorly performing equity position, which is a DWS Opportunity. And we now have a sizable position in a asset allocator, the Franklin P ratio fund, So this has simplified the portfolio. It'll execute automatic rebalancing, and there will be a little bit of greater degree of dynamism without us doing anything about it. So so we have some significant changes here, though our big holdings are not affected at all.
So what we've done, Dhirendra, is through the Franklin Dynamic PE Ratio Fund, we've maintained our 80-20 allocation. What you've basically done is removed the two fixed income funds that were dragging on our returns, on the returns of the entire portfolio. But tell us why you think Franklin Dynamic PE Ratio Fund will be able to make up for that drag from fixed income, because this is a fund that you have in a couple of other of our portfolios as well. What makes you so confident about this particular fund?
I particularly like about its simplicity, that here is a fund which will change its allocation automatically, and and the underlying investments are funds. So here is an income fund, and here is a large cap equity fund, the Franklin Blue Chip Fund, which is held in Dynamic PE Ratio Fund. What this fund does is that it brings about that it goes about executing it based on the level of the market, and it is too simple. For it to believe that it works. But I think it brings about a certain degree of timeliness in the allocation and not a wild drift. So I would and anyway, our fixed income positions were more of an allocation than a strategic or something where we try and realize our gains. So I was thinking that they are a huge drag, they are not yielding anything meaningful. Why not it be replaced by a more dynamic vehicle?
This is the change, and flashing on your screen right now is our growth portfolio. That is the investments that we have recommended. Remember, if you want this list of funds, you can always write to us at the email ID that's at the bottom of your screen. Our aggressive and our growth portfolio designed for someone who's 25 and 35 years old, respectively. We have a little bit of time in this segment. I want to squeeze in a question that's come in from someone in this age group. Bhav Jadhav has written in. He's 29 years old. He's written in from Mumbai. He tells us he's married and he's been investing in mutual funds, 1,000 rupees each through an SIP, the Birla Sun Life Mid Cap, Birla Sun Life Tax Relief, Birla Sun Life Dividend Yield, HDFC Top 200 and Reliance Growth. He also tells us he has a term insurance plan for his insurance needs, and he has a 5 to 10 year horizon. He wants you to tell him whether his portfolio is on track. Would you recommend he has to make some changes? Just from the look of it, obviously he has a little bit of tilt in his portfolio towards the Birla Sun Life family altogether. But other than that, do you want him to make any changes?
Yeah, all of them are actually reasonable fund, and one or two fund is outstanding fund. But I don't see a clear plan, and why not actually use our effort? Why not leverage on our effort and going by his age group and his necessity or his requirement? He'll do well, achieve slightly superior diversification, and get periodic advice as we are doing right now. He will be better off mapping his portfolio to our aggressive portfolio.
All right, so that's the advice coming in. Our aggressive portfolio flashing on your screen. Remember, that would be the best portfolio for you to adopt right now. The term insurance policy is an excellent idea. It will keep you covered and your family covered. So good luck with those investments. We're going to slip into a quick break. On the other side, Dhirendra Kumar is going to stay with us. We're moving to our next age group. We're talking about portfolios designed for 45-year-olds and 55-year-olds. So don't go anywhere.